Today's session we're going to learn about income from other sources section 56 to 59. Turn your subtitles on for better understanding. For that, click on the CC caption from settings, select English. I customized this session in audiobook format, or if you prefer our old whiteboard concept, do let me know in the comment section and do like and subscribe. Now let's begin with this session. Any income includable in the total income of an assessee, which cannot be included April 1st heads of income, is chargeable under IFOS head. First, let's discuss about method of accounting. Section 145. Income chargeable under the head income from other sources has to be computed in accordance with the cash or mercantile system of accounting regularly employed by the assessee. Here I give a list of income chargeable under this head. Section 56. Casual income, family pension, gift, dividend income, premium amount, income from undisclosed sources, income from subletting of a house property, director's sitting fee, remuneration received by MP, MLA, interest on bank deposit, deposits with companies or on loan, examinership fee from non-employer, rent from a vacant piece of plot of land, agricultural income from land situated outside India, interest on income tax refunds, sum received from Keyman insurance policy, compensation in connection with termination/modification of employment, advance money forfeited in the course of negotiation for transfer of a capital asset. Let's go in detail about each topic. First is casual income. Casual income includes income in the nature of winning from lotteries, crossword puzzles, horse races, card games and other games of any sort, gambling, betting, etc. Such winnings are chargeable to tax as per Section 115 BB. Section 115 BB provides that above casual income would be taxed at a flat rate of 30% plus surcharge, if applicable, plus higher education cess. No expenditure or allowance can be allowed from such income. Loss under other head or under the head of IOS is not allowed to be set off with casual income. No deduction under Chapter 6A Section 80C to 80U. Adjustment of unexhausted basic exemption limit is also not permitted against such income. Grossing up where earning given after TDS. Income by way of winnings from lotteries, crossword puzzles, card game or other game of any sort exceeding 10,000 Indian rupees and from horse races exceeding 10,000 Indian rupees is subject to TDS under Section 194B or 194BB. TDS rate is 30%. Thus, it is included in total income of the assessee after being grossed up as follows. Gross winnings equals net winnings times 100/100 rate of TDS. Some additional points to be noted: income derived from owning and maintaining racehorses is not a casual income and normal slab rate will be applicable on such income. Next point is income of jockey from such profession is not treated as winning from horse races. Last point, winning from a motor car rally is a return for skill and effort and cannot be treated as cash. Any sum received under a Keyman insurance policy, including any bonus, is chargeable under the head IOS if such income is not chargeable under the head PGBP or under the head salaries, i.e. if such sum is received by any person, family members, other than the employer who took the policy. PGBP income, and the employee in whose name the policy was taken, salary income. Interest on compensation or enhanced compensation. Section 145B, 1, provides that notwithstanding anything contained in Section 145, 1, the interest received by an assessee on compensation or on enhanced compensation shall be deemed to be his income for the year in which it is received, irrespective of the method of accounting followed by the assessee. Section 56, 2, 8, provides that income by way of interest received on compensation or on enhanced compensation referred to in Section 145B, 1, shall be assessed as IFOS in the year in which it is received. Interest received on compensation/enhanced compensation deemed to be income in the year of receipt and taxable under the head income from other sources. It is noted that a fixed deduction of 50% of interest received will be allowed under Section 57 irrespective of actual expenses. Advance forfeited due to failure of negotiations for transfer of a capital asset to be taxable as IFOS prior to assessment year 2015 to 2016, any advance retained or received in respect of a negotiation for transfer which failed to materialize is reduced from the cost of acquisition of the asset or the written down value or the fair market value of the asset, at the time of its transfer to compute the capital gains arising therefrom as per Section 51. In case the asset transferred is a long-term capital asset, indexation benefit would be on the cost so reduced, with effect from assessment year 2015 to 2016. Section 56(2)(9) provides for the taxability of any sum of money received as an advance or otherwise in the course of negotiations for transfer of a capital asset. Such sum shall be chargeable under the head IFOS, if such sum is forfeited and the negotiations do not result in transfer of such capital asset. In order to avoid double taxation of the advance received and retained, Section 51 was amended to provide that where any sum of money received as an advance or otherwise in the course of negotiations for transfer of a capital asset has been included in the total income of the SSE for any previous year, in accordance with Section 56(2)(9, such amount shall not be deducted from the cost for which the asset was acquired or the written down value or the fair market value, as the case may be, in computing the cost of acquisition. It may be noted that advance received and forfeited up to March 31, 2014 has to be reduced from cost of acquisition while computing capital gains, since such advance would not have been subject to tax under Section 56(2)(9. Only the advance received and forfeited on or after April 1, 2014 would be subject to tax under Section 56(2)(9. Hence, such advance would not be reduced from the cost of acquisition for computing capital gain, compensation or any other payment received in connection with termination of his employment. Section 56(2)(11. Any compensation or any other payment, due to or received by any person, by whatever name called, in connection with the termination of his employment or the modification of the terms and conditions relating thereto shall be chargeable to tax under this head. Taxability of family pension. Family pension means pension received by the family members of the deceased employee. It is chargeable to tax under the head IFOS. Deduction under Section 57. Least of the following is allowed as a deduction: 1/3 of such income. Statutory limit ₹15,000. Note that this deduction would not be available in case of individual assessee, who opts for the provisions of Section 115 BAC. Exemptions. Any income by way of pension received by an individual who has been in the service of the central government or state government and has been awarded Paramvir Chakra or Mahavir Chakra or Deer Chakra or such other gallantry award as the central government may, by notification in the Official Gazette, specify in this behalf. Family pension received by any member of the family of an individual referred to in subclause I is exempt in full. Section 10(18). Family pension received by the widow or children or nominated heirs, as the case may be, of a member of the armed forces including paramilitary forces of the Union, where the death of such member has occurred in the course of operational duties, in such circumstances, and subject to such conditions, as may be prescribed, is exempt in full. Section 10(19). Additional point to be noted: lump sum payment made gratuitously or by way of compensation or otherwise to widow/legal heirs of an employee who dies while in service will not be taxable under the Act. CBDT Circular. Ex gratia payment received by a person or his legal heir from the central/state government/local authority/public sector undertaking, consequent upon injury to the person/death of a family member while on duty, will not be taxable under the Act. CBDT Circular. Taxability of allowances to MLA/MP. A member of the Parliament or the state legislature is not treated as employee of the government. Payment received by them shall be taxable under the head income from other sources. However, daily allowances and constituency allowances to MLA and MP are exempt from tax/S. 10(17). Note, this exemption would not be available in case of an individual, being an assessee, who opts for the provisions of Section 115 BAC. Taxability of interest on securities. Interest on securities may be taxed on receipt basis or on due basis, depending on the system of accounting adopted by the assessee. If no system of accounting is followed, it will be taxable on due basis. Liability for tax. The person who owns the security on the due date of payment of interest is liable for the entire interest even if he is not the owner for the entire period to which the interest relates. Interest after TDS. If interest is received after TDS, then such amount is required to be grossed up to include in the total income. The interest is grossed up as follows. Gross interest equals net interest multiplied by 100 divided by 100 minus rate of TDS. Additional note. Rate of TDS, under Section 193, is 10%. In case of government securities, rate of TDS is NIL. No TDS up to 10,000 Indian rupees in case of interest from investment in 7.75% GOI saving, taxable. Bonds, 2008. No TDS up to 10,000 Indian rupees in case of interest from investment in 8% taxable saving bonds. 2003. No TDS is deductible if debentures is issued by a widely held company if interest is paid payable to a resident individual Hindu undivided family by an account payee check and the aggregate amount of such interest during the financial year does not exceed rupees 5,000.
Interest income taxable under the head Other Sources. Point 1. Interest from tax-saving bonds. Investment in notified tax-saving bonds is eligible for deduction under Section 80C. Point 2. Interest from monthly income scheme of post office. Point 3. Interest from NSC. Investment in NSC is eligible for deduction under Section 80C. Accrued interest from NSC is also eligible for deduction under Section 80C. Point 4. Interest from bank FD. Investment in 5 years notified FD is eligible for deduction under Section 80C. Interest income is eligible for deduction under Section 80TTB. Point 5. Interest from saving bank interest any bank. Such interest income is eligible for deduction under Section 80TTA 80TTB. Let's know some exemptions. Section 10.4 Interest income from non-resident external account. In the case of an individual, any income by way of interest on money standing to his credit in a non-resident external account in any bank in India in accordance with the Foreign Exchange Management Act, 1999, is exempt, provided such individual is a person resident outside India as per FEMA Act or is a person who has been permitted by the Reserve Bank of India to maintain the aforesaid account. Section 10.11 Interest from PPF. Any payment including interest income from a public provident fund is exempt. Amount deposited in PPF will qualify for deduction under Section 80C. Section 10.11a Interest from SSA. Any payment including interest income from account opened as per Sukanya Samriddhi account rules 2014 is exempt from tax. Amount deposited in SSA will qualify for deduction under Section 80C. Next topic, Section 94 Bond washing transactions. A bond washing transaction is a transaction where securities are sold sometime before the due date of interest and reacquired after the due date is over. This practice is adopted by persons in the higher income group to avoid tax by transferring the securities to their relatives' friends in the lower income group just before the due date of payment of interest. In such a case, interest would be taxable in the hands of the transferee, who is the legal owner of securities. In order to discourage such practice, Section 94(1) provides that where the owner of a security transfers the security just before the due date of interest and buys back the same immediately after the due date and interest is received by the transferee, such interest income will be deemed to be the income of the transferor and would be taxable in his hands. Let's move on to the interesting topic under this chapter: deductions allowable under Section 57. The income chargeable under the head income from other sources shall be computed after making the following deductions. Point
1. In the case of dividend income or income in respective units of a mutual fund, as specified in Section 10(23)d, or income in respective units of a specified company, as defined in Section 10(35), only interest expenditure to earn such income is allowed as deduction, subject to a maximum of 20% of such income included in the total income, without deduction under this section. Point 2. In the case of interest on securities, any reasonable sum paid by way of commission or remuneration to a banker or any other person for the purpose of realizing such interest on behalf of the assessee. Point 3. Income consists of recovery from employees as contribution to any provident fund, etc. In terms of Section 2(24)(x), a deduction will be allowed in accordance with the provisions, i.e. to the extent the contribution is remitted before the due date under the respective acts. Point 4. Where the income to be charged under this head is from letting on hire of machinery, plant and furniture, with or without building. The following items of deductions are allowable in the computation of such income: the amount paid on account of any current repairs to the machinery, plant, furniture, or building; the amount of any premium paid in respect of insurance against risk of damage or destruction of the machinery or plant, furniture, or building; the normal depreciation allowance in respect of the machinery, plant or furniture, due thereon. Point 5. In the case of income in the nature of family pension, a deduction of a sum equal to 33 1/3% of such income or 15,000 Indian rupees, whichever is less, is allowable. For the purposes of this deduction, family pension means a regular monthly amount payable by the employer to a person belonging to the family of an employee in the event of his death. Point 6. Any other expenditure not being in the nature of capital expenditure laid out or expended wholly and exclusively for the purpose of making or earning such income. Point 7. In case of income by way of interest on compensation/enhanced compensation received chargeable to tax under Section 56(2)(8). Deduction of 50% of such income. No deduction would be allowable under any other clause of Section 57 in respect of such income. Next, we going to the topic deductions not allowable under Section 58. Following expenditures shall not be deducted from any income under this head. Point 1. Any personal expense of the assessee. Point 2. Any interest chargeable to tax under the Act which is payable outside India on which tax has not been paid or deducted at source. Point 3. Any payment chargeable to tax under the head salaries, if it is payable outside India unless tax has been paid thereon or deducted at source. Point 4. 30% of expenditure in respect of sum which is payable to a resident on which tax is deductible at source. Point 4. 30% of expenditure in respect of sum which is payable to a resident on which tax is deductible at source, if such tax has not been paid on or before the due date of return specified in Section 139(1), similar to PGBP. Point 5. Any expenditure in respect of which a payment is made to a related person, to the extent the same is considered excessive or unreasonable by the assessing officer, having regard to the FMV. Similar to Section 40(a)(2), PGBP. Point 6. Any expenditure in respect of which a payment or aggregate payments exceeding 10,000 Indian rupees is made to a person in a day otherwise than by account payee check or draft or ECS through bank account or through such other prescribed electronic modes such as credit card, debit card, net banking, IMPS, UPI, RTGS, NEFT, and Bhim Aadhaar Pay. Similar to Section 40(a)(3), PGBP. Last point in this topic: any expenditure or allowance in connection with income by way of earnings from lotteries, crossword puzzles, races including horse races, card games, and other games of any sort, or from gambling or betting of any form or nature. Above provision shall not apply in computing the income of an assessee, being the owner of horses maintained by him for running in horse races, from the activity of owning and maintaining such horses. In respect of the activity of owning and maintaining race horses, expenses incurred shall be allowed even in the absence of any stake money earned. Such loss shall be allowed to be carried forward in accordance with the provisions of Section 74A, refer set off of loss chapter for Section 74A. Moving on to next topic, Section 59, deemed income chargeable to tax. The provisions of Section 41(1) we'll learn in more detail in PGBP chapter, are made applicable, so far as may be, to the computation of income under this head, as they apply in computing the income of an assessee under the head PGBP. Accordingly, where an allowance or deduction has been allowed for any year in respect of loss, expenditure, or trading liability incurred by the assessee, and subsequently, any amount is obtained, as revocation of such loss, expenditure, or remission of liability, whether in cash or in any other manner, during any previous year, then such amount received or amount remitted shall be charged to tax. Here you should note that this provision holds good even in case of succession or inheritance. Next important topic is taxability of dividend income. Basis of charge of dividend. Any income by way of dividends received from a company, whether domestic or foreign, is taxable in the hands of shareholder at normal rates of tax. Important points: dividend received from a foreign company is taxable in hands of shareholder at the normal tax rates subject to residential status and place of receipt. Next is Section 115 BBD, taxation of certain foreign dividend at 15%. Section 115 BBD provides that where total income of an Indian company includes any dividend income received from a foreign specified company, then such dividends shall be taxable at the rate of 15%, plus applicable surcharge, and no expenditure in respect of such dividends shall be allowable under the Act. Specified foreign company means a foreign company in which the Indian company holds 26% or more in nominal value of the equity share capital of the company. The provisions of this section shall not apply to any assessment year beginning on or after the first day of April 2023. Next, we moving to Section 2(22), deemed dividend. Point 1. Distribution of accumulated profits, entailing the release of company's assets. Any distribution of accumulated profits, whether capitalized or not, by a company to its shareholders is dividend if it entails the release of all or any part of its assets. Here we have to note that if accumulated profits are distributed in cash, it is dividend in the hands of the shareholders. Where accumulated profits are distributed in kind, for example by delivery of shares etc. entailing the release of company's assets, the market value of such shares on the date of such distribution is deemed as dividend in the hands of the shareholder. Point 2. Distribution of debentures, deposit certificates to shareholders and bonus shares to preference shareholders. Any distribution of debentures/debenture stock/deposit certificates etc. by a company to its shareholders or any distribution of shares by way of bonus by a company to its preference shareholders shall be deemed to be the dividend to the extent the company possesses accumulated profits whether capitalized or not. Additional note for the purpose of capital gains, the cost of acquisition of above debenture in the hands of the shareholders shall be taken to be nil. Bonus shares given to equity shareholders are not treated as dividend. Point 3. Distribution on liquidation. Any distribution made by a company to the shareholders, equity only, on its liquidation shall be deemed to be the dividend to the extent of accumulated profits of the company standing immediately before its liquidation whether capitalized or not. Point 4. Distribution on reduction of capital. Any distribution by company to its shareholders, equity only, on reduction of its capital shall be deemed to be the dividend to the extent to which company possesses accumulated profits whether capitalized or not. Section 2(22)(d). For example, a limited has issued bonus shares to its equity shareholders. Subsequently, company has reduced its share capital and refunded the amount so reduced to the shareholders. The amount so received by the shareholders to the extent of accumulated profit, whether capitalized or not, will be considered as dividend. Point 5. Important point asked in previous year question: advance or loan by a closely held company to its shareholder. Section 2(22)(e). Any payment, by a closely held company, of any sum by way of loan or advance to a shareholder, being the beneficial owner of shares holding not less than 10% of voting power, or to any concern, in which such a shareholder is a member/interest, or to any persons on behalf of or for the individual benefit of such a shareholder, shall be deemed to be the dividend to the extent to which the company possesses accumulated profits. Some additional needed to be known that first, subsequent repayment of loan or charge of interest at market rate does not make any difference in the applicability of Section 2(22)(e). Second, where loan is given and accumulated profits exceeds the loan, then the entire loan will be deemed as dividend. No consideration is to be given to the proportionate share of the IFSC in the accumulated profits. Third, if any such loan was given to more than such shareholders, accumulated profits shall be reduced by the amount of the loan given to the earlier shareholders. Fourth, dividend shall not include any advance or loan made to a shareholder or a concern by a company in the ordinary course of its business where the money lending is substantial part of the business of the company. Fifth, dividend paid is set off against the deemed dividend where a loan had been treated as dividend and subsequently, the company declares and distributes dividend to all its shareholders including the borrowing shareholder, and the dividend so paid is set off by the company against the previous borrowing. The adjusted amount will not be again treated as a dividend. Sixth, buyback of own shares. Any payment made by a company on purchase of its own shares from a shareholder in accordance with the provisions of Section 58 of the Companies Act, 2013 is not a deemed dividend. Seventh, any distribution of shares on demerger by the resulting companies to the shareholders of the demerged company, whether or not there is a reduction of capital in the demerged company, is not a deemed dividend. Eighth, in the case of an amalgamated company, the accumulated profits, whether capitalized or not, of the amalgamating company on the date of amalgamation shall be included in the accumulated profits, whether capitalized or not or loss, as the case may be, of the amalgamated company. Ninth, accumulated profits in point, distribution of accumulated profits, entailing the release of company's assets, and distribution of debentures, deposit certificates to shareholders and bonus shares to preference shareholders, and distribution on reduction of capital, and advance or loan by a closely held company to its shareholder. Above include all profits of the company up to the date of distribution or payment of dividend. Accumulated profits in point, distribution on liquidation, include all profits of the company up to the date of liquidation whether capitalized or not. Next we're going to learn about Section 8 basis of charge of dividend. Dividend declared by the company at its annual general meeting is deemed to be the income of the shareholder in the previous year in which it is so declared. Distribution by a company which is deemed as dividend under Section 2(22)(a)(b) would be the income of the previous year in which it is so distributed. Deemed dividend under Section 2(22)(e). Payment of advance or loan to a shareholder or a concern, as the case may be, which is deemed as dividend under Section 2(22)(e), will be the income of the previous year in which it is so paid. Interim dividend would be deemed to be the income of the previous year in which such dividend is unconditionally made available by the company to the members who is entitled to it. Now we are going to the next topic, Section 194 TDS on dividend payable to resident shareholders. Applicability of TDS under Section 194. The principal officer of a domestic company is required to deduct tax on dividend distributed or paid by it to its resident shareholders. Rate of deduction of tax in respect of such dividend is 10%. Time of tax deduction at source. The deduction of tax has to be made before making any payment by any mode in respect of any dividend or before making any distribution or payment to a resident shareholder of any amount deemed as dividend under Section 2(22)(a)(c)(d)(e). Non-applicability of TDS under Section 194. No tax is to deducted in case of a shareholder, being an individual, where the dividend is paid by any mode other than cash, and the amount of such dividend or aggregate of dividend distributed or paid or likely to be distributed or paid during the financial year by the company to such shareholder does not exceed 5,000 Indian rupees. The TDS provisions will not apply to such dividend credited or paid to LIC, GIC, subsidiaries of GIC or any other insurer provided the shares are owned by them, or they have full beneficial interest in such shares. Dividend income credited or paid to a business trust by a special purpose vehicle, an Indian company in which business trust holds controlling interest. Dividend income credited or paid to any other person as may be notified by the central government in the official gazette in this behalf. Next topic, Section 194K TDS on income in respective units. Applicability and rate of tax. Section 194K provides for deduction of tax at source at 10% by any person responsible for paying to a resident any income in respective units of a mutual fund, units from administrator of the specified undertaking, units of UTI, units from the specified company. Time of deduction. The deduction is to be made at the time of credit of such sum to the account of the payee or at the time of payment by any mode, whichever is earlier. Non-applicability of Section 194K. No tax is required to be deducted if the amount of such income or the aggregate of the amounts of such income credited or paid or likely to be credited or paid during a financial year does not exceed Rs 5,000, or the income is of the nature of capital gains. Next topic, going to learn share premium in excess of the FMV to be treated as income. Where a company, not being a company in which the public are substantially, receives any consideration from issue of shares in excess of the face value of such shares from any person being a resident, then consideration as exceeds from FMV of the shares shall be chargeable to income tax under the head IFOS. However, the provision shall not apply where the consideration is received by a venture capital undertaking from a venture capital company or a venture capital fund or a specified fund, or by a company from a class or classes of persons as may be notified by the central government in this behalf. Fair market value of the shares shall be the higher of the value as may be determined in accordance with the prescribed method, or substantiated by the company to the satisfaction of the assessing officer, based on the value of its assets on the date of issue of shares. For the purpose of computation of fair market value, the value of assets would include the value of intangible assets being goodwill, know-how, patents, copyrights, trademarks, licenses, franchises or any other business or commercial rights of similar nature. Next, going to simple topic previous year for undisclosed sources of income. Section 68 Unexplained cash credits. Where any sum is found credited in the books of the assessee and the assessee offers no explanation about the nature and source or the explanation offered is not satisfactory in the opinion of the assessing officer, the sum so credited may be charged as income of the assessee of that previous year. Additional amendment points added by Finance Act 2022, effective from assessment year 2023 to 2024. However, where the sum so credited consists of loan or borrowing or any such amount, by whatever name called, any explanation offered by the assessee in whose book such sum is credited shall not be deemed to be satisfactory, unless the person in whose name such credit is recorded in the books of such assessee also offers an explanation about the nature and source of such sum so credited, and such explanation in the opinion of the assessing officer has been found to be satisfactory. Further, any explanation offered by a closely held company in respect of any sum credited as share application money, share capital, share premium or any such amount, by whatever name called, in the accounts of such company shall be deemed to be not satisfactory, unless the person, being a resident, in whose name such credit is recorded in the books of such company also explains about the nature and the source of such sum so credited, and such explanation in the opinion of the assessing officer has been found to be satisfactory. These additional conditions would not apply if the person, in whose name this sum is recorded, is a venture capital fund or venture capital company registered with Securities Exchange Board of India. Next one is Section 69 Unexplained investment, where in the financial year immediately preceding the assessment year, the assessee has made investments and the assessee offers no explanation about the nature and the source of investments, or the explanation offered is not satisfactory in the opinion of the assessing officer. The value of the investment is taxed as deemed income of the assessee of such financial year. Next is Section 69A Unexplained money, etc. Where in any financial year the assessee is found to be the owner of any money, bullion, jewelry or other valuable article and the same is not recorded in the books of account, and the assessee offers no explanation about the nature and source of acquisition of such money, bullion, etc., or the explanation offered is not satisfactory in the opinion of the assessing officer, the money and the value of bullion, etc. may be deemed to be the income of the assessee for such financial year. Next one is Section 69B Investment not fully disclosed, where in any financial year the assessee has made investments or is found to be the owner of any bullion, jewelry or other valuable article, and the assessing officer finds that the amount spent on making such investments or in acquiring such articles exceeds the amount recorded in the books of account maintained by the assessee, and he offers no explanation for the difference, or the explanation offered is unsatisfactory in the opinion of the assessing officer, such excess may be deemed to be the income of the assessee for such financial year. Next topic, Section 69C Unexplained expenditure, where in any financial year an assessee has incurred any expenditure and he offers no explanation about the source of such expenditure, or the explanation is unsatisfactory in the opinion of the assessing officer. assessing officer can treat such unexplained expenditure as the income of the assessee for such financial year. It is to be noted that such unexplained expenditure which is deemed to be the income of the assessee shall not be allowed as deduction under any head of income. Section 69D. Amount borrowed or repaid on hundi other than by way of account payee check. Where any amount is borrowed on a hundi or any amount due thereon is repaid other than through an account payee check drawn on a bank, the amount so borrowed or repaid shall be deemed to be the income of the person borrowing or repaying for the previous year in which the amount was borrowed or repaid, as the case may be. However, where any amount borrowed on a hundi has been deemed to be the income of any person, he will not be again liable to be assessed in respect of such amount on repayment of such amount. The amount repaid shall include interest paid on the amount borrowed. Point A. Next, moving on to section referred to in section 68, 69, taxation of cash credit, unexplained money, unexplained investment, etc. covered under section reflected in the return of income furnished under section 139, or point B, determined by the assessing officer includes any income referred to in section 68, has been inserted to tax the unexplained credits, money, investment, expenditure, etc. which has been deemed as income. If such income is not covered under clause A. Point 2. Tax rate, 60%, plus surcharge, 25%, and cess, 4%, as applicable. Point 3. No deduction in respect of any expenditure or allowances or set off of any loss shall be allowed in computing above deemed income, point A or B above. Point 4. Benefit of basic exemption limit is also not available while computing tax liability. Finally, we are moving to last but most important topic in IFOS is taxability of gifts. For individual taxability from October 1, 2009 to March 31, 2017. For any person taxability from April 1, 2017. Gift of any sum of money or property or transfer of property for inadequate consideration on or after April 1, 2017 to be subject to tax in the hands of any person as IFOS subject to the following. Here I have categorized into table contents as nature of asset and taxable value and their particulars. First, nature of asset is money. If any sum of money is received without consideration and the aggregate value of which exceeds 50,000 Indian rupees, the whole of the aggregate value of such sum is chargeable to tax. Next, we going to categorize property movable/immovable with or without consideration. First, immovable property, land or building or both. If an immovable property is received without consideration, the stamp duty value of such property would be taxed as the income of the recipient if it exceeds 50,000 Indian rupees. If an immovable property is received for inadequate consideration, if consideration is less than the stamp duty value of the property and the difference between the stamp duty value and consideration is more than the higher of rupees 50,000 and 10% of consideration, the difference between the stamp duty value and the consideration shall be chargeable to tax in the hands of the assessee as IFOS. Students, you should know that value to be considered where the date of agreement is different from date of registration i.e. taking into consideration the possible time gap between the date of agreement and the date of registration, the stamp duty value may be taken as on the date of agreement instead of the date of registration, if the date of the agreement fixing the amount of consideration for the transfer of the immovable property and the date of registration are not the same, provided whole or part of the consideration has been paid by way of an account payee check or an account payee bank draft or by use of electronic clearing system through a bank account or through such prescribed electronic mode on or before the date of agreement. The prescribed electronic modes notified are credit card, debit card, net banking, immediate payment, real-time gross settlement, national electronic funds transfer, BARD interface for money, Aadhaar Pay as other electronic modes of payment. Next, also important point to know that if the stamp duty value of a movable property is disputed by the assessee, the assessing officer may refer the valuation of such property to a valuation officer. If such value is less than the stamp duty value, the same would be taken for determining the value of such property. 4. Computation of income under this head in the hands of the buyer. Next category is movable property, which is property other than immovable property. If movable property is received without consideration, the aggregate fair market value of such property on the date of receipt would be taxed as the income of the recipient, if it exceeds Rs 50,000. If movable property is received for inadequate consideration, if the difference between the aggregate fair market value and such consideration exceeds Rs 50,000, such difference would be taxed as the income of the recipient. Also, you should keep in mind the provisions of Section 56, 2(x) would apply only to property which is the nature of a capital asset of the recipient and not stock in trade, raw material, or consumable stores of any business of the recipient. Therefore, only transfer of a capital asset, without consideration or for inadequate consideration would attract the provisions of Section 56, 2(x). Further, the difference between stamp duty value and actual purchase consideration shall be taxable under Section 56, 2(x), only if stamp duty value exceeds 120% of the purchase consideration, if the following conditions are satisfied, namely: the transfer of residential unit takes place during the period beginning from the 12th day of November, 2020 and ending on the 30th day of June, 2021. Such transfer is by way of first-time allotment of the residential unit to any person, and the consideration paid as a result of such transfer by the purchaser does not exceed Rs 2 crore. Residential unit means an independent housing unit with separate facilities for living, cooking and sanitary requirement, distinctly separated from other residential units within the building, which is directly accessible from an outer door or through an interior door in a shared hallway and not by walking through the living space of another household. Some important points to be learned here. Point 1. Gift provisions will not be applicable if property is received as stock in trade, consumable stores, and raw materials. Point 2. Sum of money may include not only cash but also check, drafts, fixed deposits, receipts, or a NSC, alternate view possible, since it represents a sum of money though not in cash. Point 3. For this purpose, property means the capital asset of the IFSC, namely a movable property being land or building or both, shares and securities, jewelry, archaeological collections, drawings, paintings, sculptures, virtual digital asset. Point 4. Stamp duty value means the value adopted by any authority for the purpose of payment of stamp duty in respect of an immovable property. This point we will learn more in detail in capital gains video. Next we going to learn about exceptions. However, any gift received from following ways would be outside the ambit of Section 56, 2(x). It means not taxable. From any relative, on the occasion of the marriage of the individual, under a will or by way of inheritance, in contemplation of death of the payer or donor, as the case may be, from any local authority, by any fund or trust or institution or university or other educational institution or hospital or other medical institution referred to in Section 10, 23C, 4, /B, /6, VYSYA, from an individual by a trust created or established solely for the benefit of relative of the individual, from HUF on total/partial partition of HUF to members, asset received by Amalgamated Indian Company from amalgamating company, from holding company to 100% subsidiary company or vice versa where transferee is an Indian company, asset received by Indian resulting company from demerged company in a demerger. Any shares received by shareholders under amalgamation/demerger which is not regarded as transfer under Section 47. Let's see some latest amendments and exception which are effective from assessment year 2023 to 2024. Exception is not applicable if gift is received by specified persons as referred in Section 13, 3. From any fund or foundation or university or other educational institution or hospital or other medical institution or any trust or institution referred to in Section 10, 23C, from or by any trust or institution registered under Section 12AA or Section 12AB, charitable or religious trust, by an individual, from any person, in respect of any expenditure actually incurred by him on his medical treatment or treatment of any member of his family, for any illness related to COVID-19 subject to conditions notified by central government, by a member of the family of a deceased person from the employer of the deceased person, or from any other person or persons to the extent that such sum or aggregate of such sums does not exceed Rs 10,000,000, where the cause of death of such person is illness related to COVID-19 and the payment is received within 12 months from the date of death of such person, and subject to such other conditions, as the central government may, by notification in the official gazette, specify in this behalf. Here family means the spouse and children of the individual, the parents, brothers, and sisters of the individual or any of them, wholly or mainly dependent on the individual. Last but not least, relative. Let's what it says under section 56, 2x, spouse of the individual, brother or sister of the individual, brother or sister of the spouse of the individual, brother or sister of either of the parents of the individual, any lineal ascendant or descendant of the individual, any lineal ascendant or descendant of the spouse of the individual, and spouse of a person referred to in items, brother or sister of the individual. 2. Any lineal ascendant or descendant of the spouse of the individual, mentioned above. In case of Hindu undivided family, any member. Additional points. Clubbing provisions. As per section 64, 2, if a member of the HUF converts his separate property into the property belonging to the family otherwise than for adequate consideration, the income derived from the converted property shall be deemed to arise to the individual and not the family.